Taleb talks about two sort of distinctly different kinds of risk, right? I mean, you've got your everyday risk. I might win some, I might lose some, carry on the next day. But then he distinguishes that from what he calls the risk of ruin, right? Where if that one hits you, there's no coming back, right? You can't, you've lost your bankroll, and there will be no tomorrow. So can you talk a little bit about risk within the context of trading? I mean, real trading, right? I mean, you guys are out there in the trenches, right? This isn't just, trying to figure out, which ETFs to put in your portfolio, right? So can you talk a bit about the different kinds of risk that you face, and if it makes sense to you, can you talk a little bit about this distinction between risk of ruin, right? I'm going to lose everything, versus the more normal kinds of risk, the ups and downs that you face on a daily basis, and how do you alter your behavior to deal with the different varieties of risk? How do you work through that?
I think as professional traders, we always operate within the confines of our risk limits. Every institution has different risk limits, and the risk limits are designed to prevent you from risk of ruin. And in a more macro sense, senior management is very much aware of how you are positioned and how other people are positioned. And they'll make sure that no two people or multiple people are in the same trade, that if something went sideways, could cause a major impact to the firm.
Interesting. So how does that work? You get a Slack notification when you place a trade? Nope, can't do that one, or yeah, really?
Immediately. Absolutely.
Interesting.
I've sometimes overtraded, stocks. There's like daily notional limits on how much you can trade in one day. Sometimes I'm buying and selling, and I hit my peak, and I'll get an email like, "Hey, you're done." And I'm like, "What do you mean I'm
like
done?"
An overall volume limit.
Correct.
Kind of
And they're just like, "You're capped off today." I'm like, "What do you mean I'm capped off? I need more room." And they're like, "Go talk to your manager." I'm like, "Hey, boss, I need more room." Or there's also like, "Hey, you're long this stock. This person's long this stock, and this person's long this stock. Nobody else is long this stock anymore, right?"
Everybody had the same idea.
You're only staring at your book, right?
Yeah.
You're not really aware, you're talking to people and stuff like that, but you're not always aware of what people's other positions are and how things change during the day. But there's a risk management team that's their job. They're watching everyone's portfolio and how it's changing. And that's the cool thing about our desk, is that our portfolio changes a lot drastically. It changes drastically every day throughout the day. Like you can.
So is risk management front running your orders?
No.
Between the order and execution?
No. They give you a lot of rope, but as you start to approach your rope, that's when they start to lean in.
Okay. So when you hit something like that, sorry guys, but this is the nuts and bolts always interest me. So when you hit something like that volume limit that you described, can that actually prevent you from exiting a position?
It can.
That's got to be an uncomfortable place to be.
Almost immediately, I'll pick up the phone, I'll call my manager, my manager will call his manager, and I'll say, "Hey, I need an exemption. I need to raise this," and they'll raise it for you.
Interesting.
And I would assume it's a risk management position, kind of like you described, right? If it's because we got too many long positions on this security across the portfolio, they might raise it if you're going in the other direction, or
yeah. I need to I want to.
Okay, I need to raise it, but you're only allowed to raise it. We'll only raise it for the purpose of going in the other direction.
Correct. Right? Sometimes like I said, we're market making, where clients are hitting and lifting us, and sometimes we get put into a position that we didn't want in the first place that will throw us over limits. In that case, there's usually a grace period for how long you could be over your limits, right? So usually, within a few days, you want to get out of that position. So you don't have to move out of it immediately. There are intraday limits and there are intraday limits.
Here's an interesting question. So, I mean, there are certain markets that that move every tick, right? And you got to be right on top of them. But what I think I just heard is that this market moves at a little bit more of a sedate pace. Is that the case?
The single name CDS market does. The index is tick by tick.
Yeah. Okay. So let's say that you know you hold a set of positions. You're inside your risk limit. The black swan bites you, right? And the bottom falls out. So at that point, are you fired? or does the fact that you managed to stay, that this happened while you were inside your risk limits, is that some sort of a protection for you? Like how does that work in real life?
You are still responsible for the performance of your book.
Gotcha. All right. So you still got to protect yourself. And all right, so that takes us back to that question of risk then, right? Because you've got risk management that's, you know, they're paying attention to the macro, and I presume that their real focus is on firm risk, right? You know, risk at the level of the firm rather than so much the level of the individual trader. But you know, there are certain risks where, you know, if you take them, it's going to be a race between, you know, can you get rich before you get broke, right? And so when you're thinking about the risk that you take on at an individual level, are you out there in front of risk management, or are you having different thoughts than they think? Like, can you tease that apart a little bit?
Our job is to market make, right? So I'm constantly making a market for my clients to provide them the liquidity that they need to move the risk that they want. And then it's positioning myself to anticipate what the clients are going to do and have the position ready to be able to move the risk in their favor. So let's say that I have a feeling that customers are going to want to buy risk today. So I'm going to I'm going to try to come into the day long, because I know that customers are going to come in to buy and they're going to lift me out of my risk and take me short. Right. So it's kind of you're not trying to be reactionary. You want to be proactive in this business.